Ever wondered how to amp up your investment income while keeping risks in check? The answer might just lie in dividend-paying covered call ETFs. These innovative investment tools harness the power of both dividends and options premiums to generate income. At their core, these ETFs invest in a collection of stocks, usually those with a track record of reliable dividend payouts. But it doesn't stop there. What sets these ETFs apart is their simultaneous use of a covered call strategy, where they sell call options on the stocks they hold. The sale of these options brings in upfront premiums, which are then passed on to ETF shareholders as an extra source of income. But it's not all rosy. There's a trade-off to consider. If the stock's price rises above the strike price of the call option sold, the ETF is obliged to sell the shares at the strike price, even if the market price is higher. So, while dividend-paying covered call ETFs can provide an enhanced income stream, they require a careful balancing act between maximizing returns and managing potential risks. Now that you have a basic understanding of these unique investment vehicles, let's delve deeper into how they work. How does a dividend-paying covered call ETF actually work, you may wonder? Well, the mechanics of these ETFs involve a dual strategy: investing in dividend-paying stocks and selling call options. The ETFs typically invest in a basket of stocks known for their consistent dividend payouts. This provides the first source of income, the dividends. But there's a second element to this strategy. At the same time, these ETFs sell call options on the stocks they hold. This is known as a covered call strategy. So what's a call option? It's a contract that gives the buyer the right, but not the obligation, to buy a stock at a set price, known as the strike price, within a certain period. The seller, in this case the ETF, gets paid a premium for selling this option. This premium provides the second source of income for the ETF. But here's the catch. If the price of the underlying stock rises above the strike price before the option expires, the ETF is obliged to sell the stock at the strike price. Even if the market price is higher than the strike price, the ETF must sell the stock at the strike price. This is the trade-off that comes with selling call options. While the sale of call options generates upfront premiums, providing additional income to shareholders, it also limits the ETF's upside potential. If the stock's price soars, the ETF won't fully participate in those gains because it has to sell the stock at the lower strike price. So the mechanics of a dividend-paying covered call ETF involve a delicate balance. On one hand, they provide two sources of income through dividends and option premiums. On the other hand, they limit the upside potential due to the obligation to sell stocks at the strike price if the call options are exercised. So while these ETFs offer additional income sources, they also come with a unique set of considerations. It's a fascinating world, isn't it? The world of dividend-paying covered call ETFs. Are dividend-paying covered call ETFs a safe bet? Now that's a question that keeps many investors awake at night. Let's shed some light on it, shall we? In the world of investments, safety is often synonymous with lower volatility. In this regard, dividend-paying covered call ETFs generally fare better than their traditional equity ETF counterparts. The covered call strategy, which involves selling call options on the underlying stocks, provides a cushion against sharp market downturns. This can be quite the lifeboat in stormy financial seas. But let's not forget, every investment strategy comes with its own set of risks. This is no different for dividend-paying covered call ETFs. One of the key risks to consider is the potential for reduced upside potential. If the price of the underlying stock skyrockets well above the strike price of the sold call option, the ETF will be left watching the rocket from the ground. The gains that could have been are forfeited. Another risk factor is tied to the very element that makes these ETFs attractive: the premiums generated from selling call options. While these premiums provide an additional income stream, they are not immune to the whims of the market. During periods of low market volatility, these premiums can dwindle, affecting the ETF's income stream. So, are dividend-paying covered call ETFs a safe bet? Well, they certainly offer a layer of protection against market volatility and provide an additional income stream. But they also come with specific risks, such as capped upside potential and fluctuating options premiums. The key takeaway here is this: understanding these risks is not just important, it's essential. Only with a thorough understanding can you manage these risks effectively. And effective risk management, dear listener, is the cornerstone of successful investing. So don't rush into the world of dividend-paying covered call ETFs. Take your time, understand the game, and when you're ready, play it smart. As with any investment strategy, understanding and managing these risks is key to success. So, not all dividend-paying covered call ETFs are created equal? Absolutely not. Just like any other investment, these ETFs come in all shapes and sizes, each with their unique characteristics and risk profiles. Let's take a closer look at some notable examples, starting with Global X, Russell 2000 Covered Call ETF, or RYLD. This ETF targets small-cap stocks within the Russell 2000 index, and then sells call options on that index. The beauty of RYLD is its monthly distributions, making it attractive for investors seeking consistent income. In contrast, the Global X Russell 2000 Covered Call and Growth ETF, RYLG, follows a similar strategy, but with a twist. It only sells call options on half of its holdings, allowing for greater capital appreciation potential. This makes RYLG a more balanced option between income and growth. Next up is JP Morgan Equity Premium Income ETF, JEPI. This fund combines a portfolio of large-cap U.S. stocks with an options strategy. JEPI aims to provide investors with consistent income, but also capital appreciation potential, making it a versatile choice for various investment goals. On the other hand, JP Morgan Equity Premium Income Quality ETF, JEPQ, applies a similar strategy but with a focus on quality stocks. By targeting companies that exhibit strong financial health and stability, JEPQ aims to provide a balance of income and risk management. Then we have Global S&P 500 Covered Call ETF RYLD. This ETF targets the S&P 500 index and implements a covered call strategy. RYLD is designed for investors seeking high levels of income, but remember, this comes at the cost of capping upside potential. Its counterpart, the Global S&P 500 Covered Call and Growth ETF, RYLG, sells call options on only half of its holdings. This allows for more exposure to the growth potential of the S&P 500, offering a balance between income and capital appreciation. The iShares 20-plus year Treasury Bond Buy Right Strategy ETF, TLTW, is an interesting one. Instead of stocks, it holds long-term U.S. Treasury bonds and sells call options on them. TLTW can be a great choice for those seeking income with a lower risk profile. Lastly, we have the Crane Shares China Internet and Covered Call Strategy ETF, KLIP. This ETF targets Chinese internet companies and implements a covered call strategy. KLIP can offer investors a unique blend of income and exposure to the growth of China's digital economy. Remember, each of these ETFs has its own unique risk and reward profile. Some may focus more on generating high levels of income, while others balance income with capital appreciation. Your choice should depend on your investment goals, your risk tolerance, and your investment horizon. Knowing the specifics of each ETF can help you choose the one that best aligns with your investment goals. So, before you dive into the world of dividend-paying covered call ETFs, make sure you do your homework. Understand what each ETF has to offer and how it fits into your overall investment strategy. What's the cost of higher dividend yields? Let's delve into the concept of upside opportunity cost. Simply put, this is the potential gain you might miss out on when you choose one investment strategy over another. When it comes to dividend-paying covered call ETFs, this is a critical consideration. As we've discussed, these ETFs employ a covered call strategy which involves selling call options on the underlying stocks. While this approach generates an immediate income stream from the premium received, there's a trade-off. The ETF is obligated to sell the underlying shares at the strike price if the stock price rises above this level. If the stock price soars well beyond the strike price, the ETF will miss out on those additional gains. This is the opportunity cost of the covered call strategy. In periods of strong market performance, the upside opportunity cost can be significant. Investors could potentially reap higher returns by holding the underlying stocks directly, rather than through a covered call ETF. However, it's important to remember that markets can be unpredictable, and there's no guarantee that stocks will always perform well. The covered call strategy provides a buffer against market downturns and generates a consistent income stream which can be particularly valuable in volatile or declining markets. It's essential to weigh the benefits of higher income against the potential for missed growth opportunities. Each investor's circumstances are unique, so it's all about finding the right balance for your specific needs and risk tolerance. How much of my portfolio should I allocate to these dividend ETFs? This is a question that often arises when considering dividend-paying covered call ETFs. The answer depends on your age, risk tolerance, and investment objectives. For those under 30 years old, It's recommended to have a higher allocation to underlying assets, such as broad-based ETFs or individual stocks. This strategy allows you to capture long-term growth potential. A smaller allocation to dividend ETFs can provide supplemental income. This is akin to planting seeds for a tree that will bear fruit in the future. As we move into the 30 to 50 age range, a balanced allocation between underlying assets and dividend ETFs becomes more optimal. This approach walks the line between growth potential and income generation. It's about having your cake and eating it too, enjoying both the growth of your investments and the regular income from dividends. For those over 50, a higher allocation to dividend ETFs is suggested to ensure a steady income stream. As retirement approaches, the focus shifts from aggressive growth to preserving capital and generating consistent income. Underlying assets can be gradually reduced to mitigate risk. This is like enjoying the shade of a tree you've grown over the years. However, remember that these are just recommendations. Everyone's financial situation and goals are unique. Therefore, it's crucial to tailor your investment strategy to your specific needs and circumstances. For some, a higher dividend income early on might be necessary, while others might prefer to focus on growth for a longer period. Additionally, it's crucial to revisit your portfolio allocation periodically. As your life situation changes, so too might your financial goals and risk tolerance. Adjusting your allocation between underlying assets and dividend ETFs can help ensure your portfolio continues to serve your needs. In conclusion, finding the right balance between underlying assets and dividend ETFs can help you maximize returns while staying aligned with your risk tolerance and financial goals. The right balance can help you maximize returns while staying aligned with your risk tolerance and financial goals. What else should I consider when investing in dividend-paying covered call ETFs? Well, investors should always consider the tax implications of their investments. When it comes to dividend-paying covered call ETFs, both the dividend income and options premiums are generally taxed as ordinary income. This means that for those in higher tax brackets, the after-tax returns might be significantly lower than the pre-tax returns. So it's worth keeping this in mind and potentially seeking professional tax advice to understand the full implications. Now let's talk about expense ratios. In the world of ETFs, expense ratios can play a crucial role in your overall returns. Essentially, an expense ratio is a measure of what it costs an investment company to operate an ETF. It includes things like management fees, administrative costs, and other operational expenses. The expense ratio is deducted from the ETF's assets, which means it reduces the overall return to investors. So why are expense ratios so important? Well, they can significantly impact your bottom line. Consider this: a 1% expense ratio may not seem like much, but over time, it can eat into your returns. Especially when you're investing for the long term, even a small difference in expense ratios can add up to a substantial amount. For dividend-paying covered call ETFs, you'll find that expense ratios can vary widely. Therefore, it's essential to compare expense ratios among different ETFs before making an investment decision. But remember, the lowest expense ratio doesn't always mean the best ETF. It's just one of many factors to consider along with the fund's strategy, performance, and risk profile. So, when evaluating dividend-paying covered call ETFs, don't forget to look beyond the dividend yield and the premiums from call options. Keep in mind the tax implications and make sure to compare expense ratios. These additional considerations can provide a more comprehensive view of your potential investment. Being aware of these considerations can help you make more informed investment decisions. So, are dividend-paying covered call ETFs the right choice for you? We've delved deep into the mechanics of these investment tools, highlighting how they blend dividend income and options premiums to generate returns. We've also discussed the inherent trade-off, the potential for reduced upside potential in exchange for an income stream, and a buffer against market volatility. We've compared different ETFs, each with its unique characteristics and risk profiles. We've also explored the upside opportunity costs and the recommended ratios of underlying assets to dividend ETFs. And we've considered additional factors like tax implications and expense ratios. These ETFs are not a one-size-fits-all solution. They require careful consideration of your financial goals, risk tolerance, and investment horizon. But with an informed approach, they can offer a balanced mix of safety, risk, and upside opportunities. With careful consideration and informed decision-making, these ETFs can be a valuable addition to your investment strategy.